Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
And this one couldn't be any more about life insurance, to be quite honest. So
it's as life insurancey as life insurance gets.
Yes, it is. It is. It's even going to focus on death benefit. There's something we don't talk about nearly enough.
Aha. Well, how else are you going to create an instant estate, sir?
Hey.
Look at me. How else are you going to leverage your wealth, Brandon? I'm trying to get all the words in early.
Let's say cash flow. Cash flow is important.
Oh, yeah, that's right.
Let's get that in there.
That's right.
Mm-hmm. If you're new here, we're a teeny bit sarcastic. It's a character flaw, but we just...
Is it a flaw? I don't know.
Some people tell me it is.
I feel like it's my superpower.
Well, I feel the same way, but not everybody who meets me agrees. So self-awareness is something that I work on sometimes. Not a lot, but here and there. But yeah, we have a tendency to be a little less hugs and kisses to some of the stupid things the industry does. And not to say that this episode has anything to do with that. I think we're going to lean quite into that today. But,
just a disclaimer.
We're complex people.
There you go. That's a polite way to say.
It's the Insurance Pro Blog is a
far
paradox.
Less favorable. You're complicated.
There you go.
The subtext of that is something that doesn't sound quite as nice, but that's okay. So,
words we can't say on the podcast,
yeah, exactly.
Or we choose not to.
Well, we like to keep the clean tag.
Yeah, for reasons that don't make any sense, but we do. So,
we could have the world's first life insurance podcast that's explicit. That would be.
We could. I don't know where that gets us, but we could
take our audience down from 8 to 10 to 2 to 3. Yeah. All right. So what are we actually going to talk about today?
We are going to go through some of the many ways that you can create wealth with life insurance.
Okay.
And this we're going to revisit this subject in the future.
Maybe not next week. We may not do them back to back.
No, we never do that. We'd like to say it's because we space things out, but it's really just poor planning. So
it's really just because by the end of this week, we will have forgotten what our plan was. So.
Oh, yes. That happens. And also the spacing of how we record these things. No one needs to know any of this stuff. Let's talk about life insurance.
Yeah.
So
we're going to talk about how you're going to use life insurance to build wealth.
Which you can do. You can absolutely do. And life insurance has an extraordinarily unique aspect to it in regards to wealth creation.
Mm-hmm.
Because life insurance is, as far as I can tell, the only financial product that exists that you can create a sizable estate with for a very, very modest financial commitment at inception.
Yes. It is a true example of, I won't pretend that I made this up. I heard it somewhere years ago and it always resonated with me. You're literally buying dollars at a discount.
Mm-hmm.
Unfortunately, not for yourself, but for someone else, you're buying dollars at a discount. For
yourself, if you're very legacy minded and it means a lot to you to leave money to someone or something.
Sure.
That is beneficial to the individual who holds that in high regard. And we're going to talk about those types of people today, in addition to other considerations and fact patterns. Mm-hmm. But one thing to point out is life insurance is often used to protect things. And you could argue it protects estates, and that's very true, but it also creates them.
Yeah.
When you buy a life insurance policy, you have instantly created an estate.
Right.
And it's very true of permanent life insurance. It's somewhat true of term life insurance, though the estate's existence is not exactly permanent. Either way, you do have an estate that gets immediately created by purchasing life insurance, and your commitment to that, financially speaking, is very, very small.
Right.
Like, even if you try to go out and buy real estate with leverage, where your actual out-of-pocket commitment could be pretty small relative to the overall real estate value, you're still encumbered with a loan, so the net value of the estate is quite small. Right. The hope is that over time, you'll pay down the loan, the real estate will appreciate, and it'll be larger. That's the direction everybody wants to go in. Sometimes it works out, sometimes it doesn't. With life insurance, none of that encumbered aspect by virtue of having to get a loan exists, but for certain premium financing situations, which we don't need to get into today. So when you go out and just regularly buy life insurance, you are creating a significant amount of value estate-wise that you cannot do with any other financial instrument.
Right. That is true.
And that is something that really, truly sets life insurance apart from other assets, financial instruments, whatever term we want to use to identify these things.
Mm-hmm. Mm-hmm.
And that comes with some really, really advantageous strategies that you can use life insurance to accomplish if you know that it exists and you know how it works. And none of this is all that complicated, by the way. Like, today's discussion will be significantly less technical than the stuff we typically spend our time talking about.
Yes. Yeah, that's true.
So we come with a few different examples and or just strategic thought processes that you can use life insurance for in the pursuit of wealth building and, in some respects, wealth preservation.
Okay. I'm ready. I got my pencil and paper out. I'm learning. No, I'm kidding.
So let's start with something that I first picked up on very, very early on in my career, and I think gets overlooked a lot in the world of wealth creation / preservation. And that is the fact that you can use life insurance to replenish assets.
Mm-hmm. Yes.
So when you retire, you're going to have a sum of money that you are theoretically going to be using for the sake of providing for your needs in retirement.
Mm-hmm.
And one of the dilemmas that couples face is that they need to make sure the money lasts for the entirety of both their lives.
Right.
And this creates a significant amount of anxiety. Trust me, as somebody who has sat across the table from people thinking about this, I am aware of just how nervous they get about the fact that we got to make this work for both of us.
Yep.
Particularly
when in most couple situations, there's one person who's sort of responsible for managing the money, so to speak.
This is true.
Especially when it comes to retirement, and they've got, IRAs and Roth IRAs and brokerage accounts and CDs and, as I coined some years ago, most retired people have a collection of financial products that they have curated. Look at it. I'm full of buzzwords today.
We're recording this one a little bit earlier in the day than we normally do. Maybe we need to change the official time. We're just
right. So what I mean by that is this: that one person is typically in charge or takes charge of orchestrating all of those things.
That's true.
And that doesn't necessarily mean it's the person that pays the bills or whatever. That's why I was clarifying. But that spouse, whether it's husband or wife, we've seen it both flow in both directions, is very concerned about, I know how all this works and how to make things, the money show up in the checking account once a month or whatever it is. But my husband / wife is going to be completely lost.
Yeah.
If I die, they're not going to know what to do. So I need to make sure that I have enough money, and a plan, so to speak, of what they're going to do that's simple for them to operate.
Yep.
So,
yep. And more money helps open up more options when it comes to the type of people I might have to turn to.
Right.
If I'm now relying on someone else that's not my spouse to take care of this stuff.
Mm-hmm.
There's two things I want to bring up. So, one, for a number of people out there, the ability to create additional value beyond what they have been able to accumulate in a stock account, for example, is quite substantial with life insurance.
Mm-hmm.
Like, if you think about average 401k balances, which are measured in the couple $100,000 range in the United States, you can pretty easily go out and buy life insurance that matches or dwarfs that number for a relatively small cost, even as you are entering retirement age.
Right.
So you have the ability to create instantly and somewhat easily a balance of money that is on par with what you have worked for decades to accumulate with life insurance.
Right.
It's interestingly simple to do. And that gives you a lot of flexibility to ensure that you can replenish assets.
Mm-hmm.
So, like, think about a scenario where in retirement you spend money, markets do what markets do, you end up with somewhat less money than you started out with. One spouse passes away, and now you have the option, because of the life insurance, to refill the account, so to speak, and put that surviving spouse in a much stronger financial position.
Right.
That opens up a lot of doors.
Yes, it does.
It gives you a lot more flexibility in terms of how you invest the money and what you worry about. It creates the need to achieve higher rates of return, not nearly as high a priority. So if you are more conservatively minded, you don't have to worry so much about you got to be in the market because you're missing out on opportunities, even though the market makes you run for the antacids. So it does give people greater peace of mind, because the guarantees that life insurance brings to the table are something markets are never going to be able to accomplish for you.
Right. Yep.
And there's even research that has been done by Wade Pfau to point out that with life insurance as a backstop, there is more flexibility to spend more of the retirement assets.
Mm-hmm.
And you don't need as much a margin in terms of just cash on hand, because you have this other sum of money that will come into existence upon the passing of one of the spouses.
Right. Yeah. And beyond spouses, there's this legacy thing. A lot of people, this is just from being in this industry for a long time. And I think you've had the same experience. Many times people buy a policy or, several policies or whatever, in their 30s, maybe 40s, and they have one plan for that policy. Maybe they're very focused on the cash accumulation, the cash value of the policy. They're not as concerned about the death benefit.
Mm-hmm.
But you and I have talked to several people who, as they've aged, they think other things in their life have worked out well, and now they're at a place where, though they had some idea they might use some of the cash value, they don't need to. They don't want to.
Mm-hmm.
And what it does is, and a lot of people would say, well, why wouldn't you just surrender the thing? Then why do you still need the policy? It's like, well, having the death benefit there now at whatever advanced age these people tend to be, 70s, 80s, whatever, now replenishes all the money I'm spending in retirement for my grandchildren or my charity of choice or whatever they want their legacy to be. Everyone's different. But it allows them to spend more freely and not be concerned, because almost almost all, not everyone, but almost all the people we've talked to over the years are very concerned about, well, I don't want to do that because, then my grandchildren won't get as much money or something like that.
Mm-hmm.
So, the life insurance fills that gap as well.
I'm glad you mentioned charity because that's one that we skip a lot.
Yeah.
And that is a meaningful goal for a lot of people.
Yeah.
And whether it be charity or the grandkids or whomever, there is a tendency for a number of retirees to be overly conservative
Right.
about spending habits.
Right.
Because they're worried that if they spend too much, that creates what they plan to leave to their charity or their kids, grandkids, whomever. It's going to make it less than they had planned to give to them.
Right.
And again, life insurance gives them the ability to spend more money and also guarantee that they know what the amount they can leave behind is.
Right.
Because the death benefit of life insurance policy, with some very small exceptions for variable products, is not going to change, downward at least, could go up, if market downturns arrive, especially dramatic ones.
Mm-hmm.
So now, if the market forces account balances and an IRA down, that could accelerate how quickly money declines.
Right.
Because they're having to take money out for income purposes, but they're also having to sell shares at a lower value. So that's not ideal. But if life insurance exists as a backstop, now it becomes less concerning that my account balance is going down at a faster pace because I still have the value that I'm partially committed to, maybe in a charitable situation, or that I have at least committed in my mind will go to the grandkids to do whatever it is that I want them to go do with money. So it absolutely provides a freedom in terms of choices that you can make with your own money. And I referenced Wade Pfau earlier, the sum sort of bottom line statement there is a 22% median increase in what you can do with your money while you're alive.
Right.
Because you have life insurance versus just trying to save a bunch of money and be conservative about your spending habits.
Right.
That's a big increase.
Yeah.
A big increase to what you can actually do with your money.
Mm-hmm.
Now, when it comes to replenishing funds, obviously, I think there's a fairly straightforward aspect of, well, we spend money down in our 401k IRA and then somebody dies, so that comes back in, and now there's more money to use for the sake of generating income. That one's a pretty typical build out when we speak in finance circles.
Yeah.
Because people who work in finance love to talk about how you're going to generate income. Well, let me back up. How you're going to manage assets in retirement.
Yes.
Income, not always so much the big focus, but there's always kind of this concern about how much money you have and how long that's going to last you. Mm-hmm. Life insurance eliminates some of those concerns. But the other piece that does not come up anywhere near enough is the role Social Security plays in almost every retiree's life.
Right.
And the significant decrease in income, family income, household income, that happens when one spouse passes away.
Right. Yeah, exactly. Yep.
53% of Americans identify Social Security as the single largest source of retirement income for them.
Wow. Yeah, I shouldn't be shocked by that number.
And for 65% of retirees, Social Security comprises more than 50% of their retirement income.
Mm-hmm.
It's a big, big deal. But the average loss of household income upon the passing of the first spouse is somewhere between 30 and 40%.
Right.
It's a big reduction.
Yeah.
Now I know the super duper technical cerebral types are going to say, yeah, but there's only one spouse remaining, so you don't need as much income. That is I grant you that. But I have been an observer and or like very intimately involved in the process of finances when one spouse passes away.
Mm-hmm.
And I promise you, it's not an instant decline in income needs.
Right.
There is a transition period where the surviving spouse has to get used to life under the new normal.
It's a forced transition too. It's not like you have a choice.
Mm-hmm.
You have to start, and I know you've been through that. You have to start going, okay, what are we going to cut?
Yep.
Because we can't keep spending like we have two incomes when there's only one.
And believe you me, there are a lot of people who are retired, who are in this category of typical Americans that I referenced with those statistics regarding Social Security. They're very dependent on Social Security as their income source.
Right.
And they're going to take a substantial reduction in income when one spouse passes away.
And household income. Yeah.
Yep. And that is going to cause some degree of financial anxiety.
Yep.
So life insurance is absolutely a mechanism for at least buying some time when it comes to that transition period of figuring out how we're going to operate under this new regime of, again, on average, 30 to 40% fewer dollars coming in each month.
Right.
And the other thing that life insurance buys with regard to time here is a buffer from mistakes.
Mm-hmm.
Let me speak from the advantage of experience here to tell you that a number of people, both pre-retired and retired, who go through the death of a spouse, start to be thrust into a decision-making pattern where they feel like they got to make decisions fast.
Right.
Because time is ticking. And if they don't have life insurance as an additional buffer from that, lots of times there's a shoulda, coulda, woulda, like 5 years later, where they realize, the decision I made was not ultimately the right decision. And had I had a little more time to think through this, I probably wouldn't have done that.
Right. Yep. I remember years ago, long before you and I started working together, I'm sorry, someone referred to me, a widow, whose husband had just passed maybe a month before, something like that. And there were some things that happened, and she now had a sizable sum of money.
Mm-hmm.
And I think she was shocked when I told her, she told me all of her concerns and I listened. And my advice was, don't make any financial moves you don't have to make for the next 6 months, for sure. Mm-hmm. Better if you wait a year. But, there are going to be things you have to do. I understand that. But in terms of what your long-term plan is with this sum of money, don't go buy a new house right now. Don't go, buy the dream car you always wanted, things like that. If you still want to do that a year from now, go crazy. But right now you're sort of living in an emotional cloud, and you need some time to reconcile that before you start making financial decisions. And it may turn out that the things you feel right now are exactly the things you want to do a year from now. Okay, that's fine. But my point was, I think you get my point. My point was just, do the things you have to do, but don't make any big decisions right now when your footing is very unsure at the moment. So
I always think of it in the context of many, many years ago when I was much younger and much newer in the insurance world. And the many, many millions of dollars I was promised I was going to make hadn't quite rolled in yet.
Still waiting on that? Still waiting on it.
I had an older automobile that needed some work.
Yeah.
And I knew it did. And I was starting to really freak out about all the things that needed to be addressed. And then at one point I kind of stopped and I thought, I don't know how much longer I'm going to keep this car.
Right.
So I don't have to fix all the things.
Right.
I just have to fix the things that need to be done in a way that the next mechanic who needs to do an inspection will say, "Yep, we can
Right,
throw a new sticker
right.
on that."
Yeah. It's safe. That's all.
So-
that's really all we need to.
Like, that's what I need to address. And then if I decide I'm actually going to keep this thing, I can start addressing those other things. And if I decide I'm not, there's no point in spending the money on that.
Right. The car's not worth much as it is. So it's not.
For people in this position,
Yeah.
recently losing a spouse, like there's lots of people who tell them, "Oh, if you got a bunch of money that you come into, you you can't forfeit all of that possible gain. You got to start figuring out how." No. You can put it in the bank and collect interest.
Yeah.
And even if you've got to take some of that money out to cover income expenses, we're not talking about doing that for the rest of your life. We're talking about doing that for the next 6 to 12 months.
Right.
That loss is immaterial when it comes to opportunity costs and things like that.
Right.
And you could go out and make a much, much, much bigger mistake trying to rush into things
Absolutely.
that you will come to regret.
100%. Yep. That doesn't mean there's no planning you need to do, but there's no big decision about what am I going to do with all this money that you have to make.
Right. It just buys time to help clear your thoughts a little bit better. The other thing that life insurance can bring to the table, this is not universally true, so we have to be a little careful about selection of life insurance policy. But there are many out there that'll do this. They can give you some hedge against the costs associated with declining health and long-term care.
Mm-hmm.
The death benefit can be accessible. Call those accelerated death benefit riders, specifically for chronic conditions.
Yep.
And they're not a replacement for buying long-term care insurance. I don't want to say that. But they do act as another reasonable way to at least address some of those expenses.
Right.
So if you own one of these policies, you have more protection of your other assets against the expense of declining health that requires care from qualified practitioners to either come to your home and assist with things or go to a nursing home or adult daycare facility and have the money to pay for it.
Right.
Which again, doesn't eat into your other assets that you were planning to do something else with or leave to someone else. And with life insurance, unlike long-term care insurance, traditional long-term care insurance, you have the understanding that this exists to help defray some of that expense. But if I never end up needing any of it, then the benefit of the life insurance will go to wherever the other plan is, the children, grandchildren, charity, whatever that may look like.
Mm-hmm.
So that is another way to build and preserve wealth. And then the last item that I wanted to talk about today, which is something that we have addressed casually a few times, is the fact that dying costs money.
Yeah. I don't know why I laughed. It's an uncomfortable laugh.
And taking the stuff that you own and giving it to the people you want to give it to after you're dead also costs money.
Yep.
And in the finance world, we like to pretend like we're super duper sophisticated, and we always talk about the big one, the federal estate tax. The truth is, very, 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 very few people have to worry about that.
Right.
And the other truth is, very, very, very few advisors out there have ever been involved in the process.
Right.
Of an estate that is subject to the federal estate tax.
Mm-hmm.
But almost every single one of us has been involved in a situation where someone has died and there are more than originally assumed expenses associated with the process of getting the money where it is to where it ultimately needs to go.
Mm-hmm. I will say that in my experience with estates, meaning someone has died and there is now an estate, right?
Mm-hmm.
If all the person owns are accounts of various kinds, brokerage accounts, IRAs, that sort of thing, bank accounts, takes time, but not terribly complicated and not super duper long and drawn out.
Not generally.
The hard part becomes hard assets.
Mm-hmm.
And or business interests.
Yep.
I mean, I was talking to some people not too long ago who's had a relative who passed away over 2 years ago now. State's still open because of real property. And we're not even talking about like, it's not a problem. It's not like warring family members or anything. Nothing bad is going on. It just takes a long time because there's all sorts of machinations that you have to go through. There's different parties involved. And so, of course, the legal bills and accounting fees and all that stuff keeps adding up.
Mm-hmm. And the other thing that happens when it comes to hard assets, some of them, real estate's the big one, have carry costs.
Yeah, absolutely.
And those don't go away, nor do they get suspended because someone died and you're waiting for the attorney to file some paperwork. Or
if you own a commercial building or even a single family home and you have tenants, right? In either of those situations, well, guess what? The tenants still expect you to fix things and do all the maintenance and all that sort of stuff.
But technically speaking, like if this is real estate, a rental unit owned by somebody, or owned by an LLC that they own, and those tenants are writing checks to the now deceased owner or that LLC, right? You don't just get to walk in and say, "Well, I'll take care of that for you." No. There's a process to taking over. And it can be a little convoluted, and it gets easier if there is just a sum of money. Yeah. And there are non-life insurance ways to kind of expedite that process. Mm-hmm. Titling certain assets as joint accounts, TODs can work for the most part. Trusts. Yep, trusts are another one that people do. So that all, and those are fairly instant, most of them. Mm-hmm. Life insurance is very instant too, because the beneficiary identifies themselves to the insurance company, provides proof that the insured is now deceased, and the insurance company pays the beneficiary. Right. That's a very simple process that on average takes place over the course of a couple weeks versus several months. Yeah. Even the process of going to a bank and saying, "Hey, this person has passed away. Here is the evidence of that. We now need to transfer the assets." Like, let's say it's a TOD account. Mm-hmm. I've run into some situations where that took an unusually long, or that took a much longer time frame to finalize than I was expecting. Right. Absolutely. And the bank asked for some really weird stuff for whatever reason. Mm-hmm. And here's the other, every state is different too. Yes. As to what's required. Yes. But again, money creates, cash value from life insurance, death benefit cash from life insurance creates more flexibility because now you have cash on hand. Now you can just come in and pay certain expenses if they need to get paid. Right. And again, your real estate example is one of the biggest headaches that gets created for people, because it could be the primary residence, could be a vacation home, something along those lines. Again, there are certain things, insurance, property taxes, electricity bills, heating fuel. Those are all things that sometimes have to get paid. And very, very infrequently are any of those things something that you can just go to some person and say, "Hey, this person died, so we're going to need you to just hold off for like 6 months and then we'll get your money to you." That rarely is a negotiation that works out well. Yeah. So life insurance is absolutely a way to create the money that's necessary to pay those people and make the issue go away. Right. So death claims are not always instantaneous, but they're a lot faster than probate process. They are. And one of the biggest mistakes that I've seen people make when it comes to, hey, there's real estate, but then there's a few other assets, is like a good example. we have this real estate, but it's okay. There's like $500,000 sitting in our IRA. So the kids are going to get the IRA, and if they need some money to deal with the real estate, they can just take it from there. That is technically correct, but the income tax implications to the children is complicated.
Yeah.
Because
and even let's back it up even further. Even if the children are, this is assuming the children are beneficiaries on the IRA, right? So it's a contractual thing, not a probate thing.
Yep.
So that's the smoothest thing possible. But I've learned over the years, depending on where you live, death certificates, the length of time to get a death certificate varies wildly.
Yes.
From,
yes, it does.
And that's a local thing. So like from, place to place. Around me, doesn't take that long. But I've heard of, a month or more. That's a long time.
Yeah, you got to sit and wait.
Yeah. Especially if you're depending on that money to do something, is my point. Yeah.
Right. And there's a lot of things that can happen, especially with real estate, that can damage the value of the real estate.
Right.
If things are not addressed.
Sure.
Automobiles are another one. If they just kind of sit.
Yeah.
Because no one's going to touch it right now.
And getting an automobile retitled. I know down here, that's one of the most, I won't say complicated, but it's not fast.
Correct.
I mean, there's a very specific set of documents that you have to have, but, and then you just have to send it in and wait.
Yep. Now, I want to call something out that for some people may be obvious, but I don't think it is a super obvious statement. All of these examples that we've walked through are not things that you have to individually and specifically buy life insurance to address on a one-on-one basis.
Right.
Life insurance is adaptable in the sense that you could do all of these things with one life insurance policy.
Or none.
Or none. Or you could buy it with the intention to do one of these things, but it ends up coming in handy for something else.
Yes.
So you buy it because you think, hey, it would be great to have the additional cash to replenish assets, but ultimately you don't really need to do that. But it does end up being helpful for Social Security replenishment of income, and then it also becomes helpful to deal with the transfer of assets at some point.
Yeah, right.
Ultimately, a little extra cash is really what it can help do for the sake of building wealth. And it's easy to overlook, but we shouldn't. The instant estate creation, and for those who are really legacy minded or those who are really looking to try and build generational wealth, it is certainly one of the ways that can help put you closer to accomplishing that goal.
Right.
So while we worked through some very specific examples, it is very, very worth noting that life insurance is versatile enough to address all of these things, and you don't have to change the policy to do that.
Right. No.
And that was
there's nothing specific.
Yeah. That was basically my last thing to blow hot air at today.
Well, I've said all I needed to say.
All right. Then we can end it there. I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.